Hello, I'm Jerry Theodorou, Director of the R Street Institute's Finance, Insurance, and Trade Program. Thank you for joining our webinar today on Reconciliation Lookback, Farm Subsidy Policy, and the Future of the Farm Bill. I'm delighted that we've got two fantastic panelists to shed light on this very topical and timely discussion subject. Vincent Smith is the director of the American Enterprise Institute's Agricultural Policy Study Program and is a professor emeritus at the Montana State University Department of Agricultural Economics and Economics. Caroline Melear is my colleague at the R Street Institute, the Finance, Insurance, and Trade Program. She's a fellow, and Caroline has written and spoken on many of the issues we're going to be covering today. So we're delighted to have you, Vince and Caroline, on this event. Now, before we get into the nitty-gritty of what's in the reconciliation package and how it impacts crops and farms and crop insurance, I'd like to provide a little bit of context because it's important to know where the programs that we're talking about today, where they started and how they've changed and what that suggests about policy reforms. Now, the roots of the Farm Bill take us back to the 1933 Agricultural Adjustment Act. At that time, it was introduced to support farmers who were struggling with two humongous challenges, burdens. There was the Dust Bowl, which literally blew topsoil away from many states and left in their wake parched, dry fields with no crops. And it also was of course, the time of the Great Depression, and farmers were poor. The farm workers were traveling around the country looking for vegetables and fruits to pick. Some farm workers starved. It was a really challenging time. Many of you may have seen that iconic photograph by Dorothea Lange, migrant uh, migrant farmer, a woman with her two children there, looking very anxious and wondering where their next meal would be coming from. So there were those two issues that were really pregnant and very important: soil conservation and providing food. As a matter of fact, that was the beginning of the food stamp program in 1939, with all the folks that were hungry and didn't have means of getting food. So that program was there, and there was disaster aid, which was eventually supplanted by insurance. Insurance was thought to be a more economical way to support disaster relief, but as it goes with unintended consequences, insurance became actually 6 times more costly than the disaster aid predecessor to that. And since the 1930s, the crop insurance program has expanded so that it provides more and more subsidized insurance and virtually guarantees the income that farmers get. It's become an exceptionally unnecessarily generous program. The program is administered by there's 11 companies that are called approved insurance providers, private insurance companies that administer the program with loss adjusting and administrative clerical uh, services. There are subsidies that the approved insurance providers get for reinsurance protection and the administrative and operating costs. They get reimbursed for that. And also there is subsidization of the premium to a huge degree. The farmers that are in the program are only paying 1/3 of the actual actuarially determined premium. So it's like they're if I were a farmer with this program, I'd be giving you 30 cents and you give me $1. That's a game I'd like to play all day long, and it's led to billions of dollars in subsidies that take away from real sound risk management. So that's the history. Now let's look at the current landscape. If we look at who are the folks that are buying crop insurance, it's mainly the largest farms, which are agribusinesses that have over $1 million of revenue per year, owning 25% of the nation's farmland, but only accounting for less than 4% of the farms. So it's dominated by these large agribusiness players. And whereas you may hear, or you have heard, or you will hear stories about farmers suffering economically, that really hard pressed, It's not true if you look at the numbers. The numbers don't lie. Median farm family income, annual income, is $98,000, which compares favorably to the national median of $75,000. So income for farm families is 30%, 33% higher than for all families. And get this, if we look at the assets, if we look at the assets, the net worth of farm families, we're talking about $1.4 million. That sounds like a lot. It is a lot because it compares extremely favorably to the average or the median family with $193,000. A huge difference there in wealth. Now, the main subsidy programs, there's one called PLC and another that is called ARC, are for the production of crops, the bushels per acre, and ARC is for revenue, so that farmers have got these guarantees that prevent them from going below a certain threshold and a lot on the upside. And the rates that are, or the prices that are set there that govern the program are affected by what's known as the reference prices. So, Vince, if we can start with you to shed a little bit more light on how these reference prices are introduced and what they do.
Uh, so the way I try to explain what are very complicated, rules-driven, regulation-driven programs, the simplest way to think about the reference price is that you have two options. You can either opt for the price loss coverage program, and in that program, if on a national marketing year basis for a crop, the reference price that is established by congressional legislation is higher than the market price you get, you're paid the difference between the two numbers on all eligible production. Now, how that's calculated is based on a farm's history in terms of acres planted to a covered crop, say corn, wheat, or rice, and the farm's history of yields for that crop. The other option you have, if you don't like that price loss coverage option, you don't think it will generate large amounts of subsidy for you. An example there has been soybeans over the last 8 or 9 years. Then you're going to opt for what's called the agricultural risk coverage program. The way that works is for almost everybody participating, for the crops that you're covering, there's a county average yield established nationally by national databases run by USDA. That's multiplied by the reference price. And if in your county yields are low or prices are low, so that the revenue per acre is smaller than the reference price times the county average yield as established by USDA, you get the difference in that payment on the acres that you're eligible for payment. Most people today opt for a price loss coverage option. That's using the pre-reconciliation bill reference prices. The reconciliation bill jacked up those reference prices very substantially by between 10 and 20%, depending on the crop you're looking at. What's really interesting, though, is that estimates from the University of Illinois show that for the 6 major crops that receive, whose growers receive 94% of all payments under this program on average in a typical year, the impact is much bigger than the increase in reference prices in terms of the amount of dollars of subsidy that they are going to receive. So we have, for some crops in particular, and these are very small acre crops, we have, and I'll explain what I mean by small acres in a minute. For peanuts, the estimate is that the increase in reference prices in the reconciliation bill, Title I, will more than double your expected annual payments that you get. Now, there are about 7,000 peanut growers in the country, and the estimates from Illinois are that this bill, the reconciliation bill, will increase those payments to that group of growers, those 7,000 farms, by over $3 billion. Seed cotton, which is raised by around about 13,500 farms, the payments to that group will go up by $6 billion, again, more than doubling from the previous levels they're expected to receive. The other biggest winner is rice. For rice, those payments will go up by 185% on average, an increase of, again, of $8 billion, basically. And how many rice growers are there in the country? Well, in 2022, when the agricultural census was carried out, there were about 4,000 rice producing farms. So the other interesting fact about this program is that all of the payments will be heavily concentrated on the largest farms. Dramatically, the largest 1% of farms, if you took all farms, all 1.9 million, there's about 1.9 million farms, if you rank them from smallest to largest in terms of revenues, the largest 1% of farms will get 10% of all subsidies, and the largest 20% of farms will get well over 70%, close to 80% of all subsidies. And the largest 10% will get 2/3 of that money. Very little goes to the small and mid-sized farms that are often characterized as most in need of help. This program is not about helping struggling beginning farmers, struggling small-scale operations. It's a big farm, big agribusiness, if you like, program for very few farms.
Yeah, right. And Vince, hear what you say about rice, peanuts, cotton. How is it? Yeah, how was it that the support has increased so dramatically? Was it effective lobbying, or what went into the calculations?
For as long as we can remember, cotton, rice, and peanuts, which are often called southern state crops, have been very effective in lobbying their representatives and senators to get, relative to their importance in the agricultural sector, which is really quite modest, a disproportionate amount of subsidies. The peanuts are the most egregious example. For many, many years, under previous legislation, peanut growers were going to receive payments almost every year, and well over $100 an acre for the peanuts they grow. Effectively, it's not unreasonable to simply state that peanut growers grow peanuts for the subsidies, for harvesting the subsidies, perhaps to a greater degree than anyone else than the rice growers in California and Arkansas.
Right. So instead of harvesting the soil and harvesting the crops, they're harvesting the programs. Caroline, you've written in the past on specialty crops, and if you can shed a little light on what they are and what some of the expansion is. Vince has talked about the six main crops that are there, but I've read that popcorn may be considered a specialty crop, and chickens also. What have you heard on specialty crops, and what are they?
Yeah, specialty crops sounds like it would be like exotic sort of things. It's not. It's basically fruits and vegetables, which should ideally be part of a cornerstone of a healthy American diet. Although I think that It's no secret that we are lacking in that area in the United States. So we certainly see, and I have written about this, as you said, we really see the government picking winners and losers here. Vince has certainly alluded to that as well in some of what he has said, but we have these 6 main crops that really get the vast majority of the subsidies. And that's not to say that fruits and vegetables should start receiving the same type of government handouts and taxpayer subsidies, but it does lead to sort of a situation where we find that you go to the grocery store and you are going up and down the aisles of the processed, any of the packaged or processed goods, you're going to find almost certainly at least one of those 6 main crops in there, whether that be in the form of oil or sweetener. And that's mostly stuff that is fillers, that's not particularly nourishing or satiating to the human body. So we have a lot of health impacts that are coming from this as well. And it is discouraging that we have a subsidy program which is not focused on the nutrition of the American public, when that is such a concern in so many other areas. We did see a little bit of rollback with SNAP and what that is going to be allowed to be used on, but to me, the problem, you take it a few steps back, and I think that we can see this from the Make America Healthy Again movement, which, whatever you may think about that it is a good opportunity to be a little bit more focused on the health impacts. And I think instead of forcing companies to put certain ingredients in or take certain ingredients out, let's go back to the beginning and say, why are they putting these ingredients in the first place? Well, it's because they're artificially cheap because taxpayers subsidize them to such a dramatic degree. So I think that evening the playing field at the very least would be beneficial for Americans' health, and that's just something that is very important to me. And it's like I said, it's very disappointing to see how backwards our subsidy structure is. It's Vince alluded to this as well, that we hear the argument that it's really to support the small farmers, which in practice that's not what we see happening. But I would hope that we would have a farm policy and a nutrition focused policies that are actually care about our health. And again, you can see these savings down the road too, when you look at all the health problems that Americans have that are so closely related to their diets, obesity, diabetes, certain cancers that really stem from our poor dietary choices. So the government has a really, really heavy hand to play in the choices that we see in front of us at the grocery store.
Yeah, the stamps, the food stamps, and the provision of subsidized food to poor folks started in 1939, about the time of the introduction of the Agricultural Adjustment Act. And since that time, food stamps became now known as SNAP. And I read very recently that about 10 million Americans are recipients of SNAP. Do either of you have any insights or comments as to what is in the reconciliation bill that affects SNAP and the idea of the magnitude of that?
There are 2 ways of looking at the SNAP program. One is to view it as a program to put food on the table. And if you take that perspective, which is actually a narrow perspective, then you're going to look at the reconciliation bill. The information on changes is all in Title I. And you're going to say, well, there's a lot of good in that. The difficulty with that approach is that if we look at the extent to which in the US, we have income transfer program for low-income families. If you add SNAP to other programs, it turns out that on a percentage basis, at least, the US ranks very poorly in its work to help low-income families. So there's this interesting discussion that we've not had about the SNAP program and about, which is, how critical is it simply as an income transfer program rather than viewing it as providing access to food? And most economists would view the program as adding income. An important thing to understand about the SNAP program is that the average recipient spends double the amount of money that it receives from SNAP on food. That is, if you're spending $100 a week, let's say, on food, $50 will be from SNAP for the average SNAP recipient family, and $50 will be from other income that they have. So this is fungible money in an important way. The bigger question for SNAP, and this is all I can really say about SNAP at this point, is that it doesn't make sense to most economists to have a food subsidy program serve as the major or almost the major income transfer program to help low-income families. Rather, an integrated social safety net program for low-income families makes a lot more sense than the SNAP program as currently constituted.
Yeah.
And
You were saying,
oh,
go
sorry.
ahead, Caroline. No, please.
I was just going to add to that. There was a lot of discussion and argument, I would say, about eliminating the ability to purchase what would kind of typically be referred to as junk food from SNAP. That did not ultimately make it into reconciliation, but there are state level efforts because so much of the burden of SNAP is going to be now pushed to the states. There is some effort at the state level to not allow purchases of sodas, candies, those type of things. And I do not have the figure top of mind. I apologize for that, but there is a really dramatic percentage of SNAP benefits which are used on soda in particular, which is quite interesting.
Yeah, the states that you're referring to, Caroline, are states like Nebraska, Oklahoma. I'm trying to think of the other states. The challenge here is always, given that a SNAP family is spending only half of its food budget using SNAP dollars, what will be the real impact? And the flip side of the concern is, if we put more regulatory constraints into the program in that context, are we really changing behavior? And it's surprising how little research has been done on that question. It's unfortunate that little research has been carried out in that area in terms of what happens if you prohibit the use of SNAP for high sugar content drinks, whether it's Gatorade or whether it's Coca-Cola.
Yeah, Vince, you mentioned research. I think the first time I met you, it was at a conference when you were pointing out that there's very little research and development going on in the United States food industry compared to Europe and places that are looking for more efficient ways of farming, and that we're falling behind in research and development. Do you have any comment or summary of what your thoughts are on research development and how that compares to the rest of the world? Is there anything that we could emulate or do better, or does it not matter at all? Well, what are your current thoughts on R&D?
In the last 15 years, and this spans both Republican and Democratic administrations, and Congress is controlled by either the Democrats or the Republicans, we have seen in real terms public funding for R&D, which turns out to be critical to productivity growth in the agricultural sector. We've seen it decline back to levels we hadn't seen since the mid-1970s. So today we're spending less as a nation on publicly available information about agricultural productivity, which is critical to the value to private companies of their research, by the way, than we did in 1975, once you worked out the inflation impacts. The evidence is that correspondingly, with a lag of a few years, productivity growth in the US agricultural sector has shrunk so that now it's close to zero. And many of the experts in this field, for example, Phil Pardee at the University of Minnesota, but others as well, including USDA economists who are no longer there because of the various Doge cuts, were identifying the possibility we were going to turn negative in terms of productivity growth because of the lack of sustained investment at the public level in agricultural R&D. And one of the big issues, one of the really important issues with respect to nutritional foods is the extent to which we actually have public R&D funding for, in general, and for specialty crops and so on in particular. Because one way to increase consumption of a particular type of food is to lower its effective price. And that gets done when we become more productive. And you will meet farmers who say, oh, well, if we invest, your investments are going to raise total output of, say, corn or wheat. And I've heard Iowa farmers assert this more than once in my life. I'm just picking on Iowa because it's the big corn, soybean nexus. The bottom line is that farms benefit from increased yields, which means that per bushel of corn, they're able to raise those crops at lower total cost. A lot of the discussion, by the way, about costs of production focuses on prices of inputs, but ignores impacts that have occurred over time on yield growth. That's just an aside. So in terms of developing healthy diets, one key aspect of that is to generate marketplace incentives for individuals to focus on different foods. And so that's where R&D in general becomes critically important. It's not just, can we raise more corn or soybeans? It's, can we make those apple orchards more productive or more effective? Or the cucumber productivity. And I'm picking these sort of individual products, but the general principle holds across the broadest spectrum of agricultural commodities, including livestock.
Right. And speaking of livestock, do you have any insights as to whether chickens, fowl, may be introduced into the program, or other kinds of crops? I mentioned popcorn, came across that in my reading.
The biggest shift, let me rephrase that. A major driver of the increase in the use of heavily subsidized crop insurance has been in the livestock area. Under the 2018 Farm Bill, much higher subsidies were introduced for a variety of livestock insurance and livestock price insurance products. The uptake has been quite dramatic, accounting for about 20% now, as opposed to less than 1% of total crop insurance liability that is subsidized by the taxpayer over the last 4 or 5 years. My colleague, Eric Velasco, has an AI paper that just came out looking at the growth of livestock insurance. And the taxpayer is going to be on the hook for this. Up to about 2020, the total amount of subsidies that were being paid by taxpayers into the crop insurance program was about $10 or $11 billion a year. The current CBO, Congressional Budget Office, forecasts for the next decade are that annually those numbers are going to go up to $15 billion in terms of farm subsidies. And those subsidies, by the way, are going to be heavily concentrated on about 150,000 farms. Those additional subsidies, along with crop insurance companies. Just as an aside, Jerry, you mentioned earlier right at the outset of the discussion that the crop insurance companies get subsidies to basically run the federal crop insurance program in terms of delivering, selling, and servicing policies. What blows many of our minds as economists, those of us who've looked at the program, is that for every dollar of subsidy a farmer receives, the crop insurance companies end up getting 40 cents. That's a really expensive way of writing a check to a farmer. So if you're sending the farmer $10,000, you're writing another check effectively to the crop insurance company of $4,000. That is a very expensive way to go to transfer income to farmers.
I think that's such an important point. And that was something that Jerry and I highlighted in our paper that we wrote on crop insurance a few years ago, was the guaranteed profit margin that the approved insurance providers receive, which is, there's a lot to unpack with that statement, right? But they receive well above what a typical profit margin would be for an insurance company at almost 15%. And that is a guaranteed margin by the federal government, which is not too bad for their business, but not ideal for the taxpayers.
Well, I think that's exactly right. And we'd have to get into the weeds to explain why it's guaranteed, but I completely agree. It is guaranteed in the way in which premiums are being set for these programs, of which the farmer, under the new reconciliation bill changes, will, as Jerry pointed out, only have to pay a third, and the taxpayer picks up the other 67%. If only you and I could get that deal on our homeowners insurance or our car insurance, we'd be a lot happier than we are when those bills show up at our door. Unambiguously, farmers only buy crop insurance because it makes them money. You will hear people say, oh, it's a massive risk management tool. The research that has been done by people like me and my colleague, Barry Goodwin, unequivocally show that if you make available a heavily subsidized crop insurance policy to the farm moves away from actually putting on the ground risk management tools in place to ensure crop production is not adversely affected by weather. You've got incentives for not quite, but sort of the analog of the mafia burning down the restaurant they own to get the crop insurance payment, because you're incentivizing farmers not to produce crops once they know they're going to get an indemnity in the first place. Why would I raise a crop when the government will pay me if I don't raise that crop by, say, adding fertilizers or controlling weeds?
Yeah, and some of the difficult things to wrap your head around also is the way that the margins that Caroline referred to, the approved insurance providers, have basically guaranteed profit margins of 14.5%. The long-term average for property casualty insurance companies is a 6% margin, 600 basis points. So it's a very profitable line of business for those companies that are there. And in order to prevent it being improved from a policy standpoint, in 2014, in the 2014 Farm Bill, there was the protection that if there's going to be any savings from the insurance agreement, which determines the prices and the subsidies, if there's anything that saves the program money, then that money that was saved has to be paid into the program. So it's airtight. The system is really solid there. I remember there was a Texas listening session. We talked about cattle, and the spokesman, one of the people that spoke at this listening session for farmers or for ranchers, were saying we must absolutely have more money. So, as you put it, Vincent, that throwaway line, it's about making money rather than harvesting in the most efficient way. And then going back a little bit to the demographics, which are quite striking, and tying it into what's happening today, uh, what's in the reconciliation bill. There were a couple of loopholes that were introduced, which I think are concerning. Uh, with the new bill, you have an increase in the maximum amount a farmer can get of $155,000 per year, up from 125,000, and that also applies to the spouse if there is a spouse. So that was raised, and multiple other family members, cousins, can also be added to that. So you take the 155,000 and multiply it by 5 or 6, and you're skirting close to 1 million. So that was one loophole, and the other one opens the door for different structures, corporate structures for the farmers, limited liability companies, LLCs, pass-throughs, S corporations, so that you've got more types of farms with these alternative capital structures that are now capable of enjoying the benefits from the program. So these are two loopholes that you'll see. So as those of you that are listening, and if you see the news, follow what's going on with loopholes, because they will basically bloat the program even more. I don't know, Caroline or Vince, if you're keeping up with the discussion on these loopholes and have any comments on that, the 155,000 and the farm structure.
Caroline, do you have comments? Because I have
go ahead,
lots of
Vince,
comments.
please. Yes, please go ahead.
Well, many years ago, I was invited to talk to the Minneapolis Fed's Agricultural Committee, a whole bunch. There were basically 10 farmers in the room. They were 10 very successful business people who owned farms in the room. Very gifted people, very smart. And this was before the 2008 Farm Bill. And the only real issue they were concerned about at that time was that the number of eligible people for payments on a per farm basis was going to be reduced from 3 to 2. That's all they cared about. But these were operators with extraordinarily large farms. If you look at the amounts of money received under the ARC, the Agricultural Risk Coverage and Price and Loss Coverage, major price and income support programs, less than 2% of all farms are currently affected by the limits that existed prior to the passage of the reconciliation bill. So now if you ask a different question, out of those farms, how many would really want this exception, this loophole? You're talking about less than 1% of all farms. And they are the very largest farms. So this is actually a loophole created for exceptionally affluent, large farm owners, and it's a critique that you could levy with respect to the tax bill, in that this is a loophole designed for the wealthiest people in the country who happen to own farms. It's that sort of loophole. It's not going to affect 98% or 99% of the farms that currently are eligible for these programs. It's the largest farms that are going to benefit from this. And of course, that cap, which would come out at about $600,000 in payments now, does not apply to any of the premium subsidies that the largest farms will get, because crop insurance subsidies are unrestricted on a per farm basis. So there are farms that receive over $1 million a year simply in crop insurance premium subsidies. Not a whole lot of them, but they exist. But those subsidies will not be part of this constraint on total subsidy payments. It only applies really to the price loss coverage, agricultural risk coverage program, and some much smaller other programs for other commodities.
Right, and sorry. Yeah, and as you say, Vince, these folks that benefit from that loophole are not dirt under your fingernails farmers. They are, if you look at the addresses of the participants or the people that are in the program, you've got big cities there. These are folks that are not actually farming actively. They have an ownership maybe in a farm, but they're living far away from the farmstead. So it's a totally different picture from that migrant farm woman looking for a place to pick snow peas because the crops in Oklahoma were ravaged. So it is a program that has strayed far from its original goal. And let me remind you that this was about soil conservation, to restore the topsoils in the country so farms could grow productively, and also to take care of farmers that were indeed in dire straits, as they were. So all this, if you look at the literature, has kind of exploded the myth of the family farm. Analyzing the data shows that it's not necessarily a family business. It is a business, and it's a business that harvests the benefits that are there.
One of the really interesting facts about farming is that if you are a successful farmer, whether you're raising lettuce or whether you're raising corn or whether you're running a 10,000 cattle herd or a 10,000 head dairy farm, these are sophisticated businesses managed in general by well-educated owners and operators who are technologically sophisticated, are sophisticated business people. In 1930, over 40% of the total population lived on a small farm. Today, the percentage of the population that is engaged in farming as owners and operators is 1% of the workforce. And if you add in hired hands, some full-time, many on just over the harvesting and planting season and so on, you can get that number up to 1.5% of the workforce is engaged in farming, which tells you something about the different nature of farming. I remember as a young kid in the early 1960s, it tells you I'm very ancient, watching a video at my grammar school where very proudly a farmer, almost certainly from Iowa, though I wouldn't want to swear to that, said, "My farm feeds over 50 people." Well, today, that farm feeds just domestically 100 people and globally 150 people. And by the way, that's a good thing. The other thing people forget about farming is that physically it is a risk, it is an occupation where the incidence of workplace-related injuries is higher than in many other sectors of the economy. Mining would be an exception, forestry would be an exception, but it's not a low-risk occupation. And the development of great technologies that reduce the risk to the the worker on the farm, whether it's the owner and his family or her family, or whether it's a hired hand. That's wonderful, and we should celebrate that. What we shouldn't celebrate is the failure of the interest groups associated with farming to focus on the decline in agricultural R&D funding. One of the fascinating things about agricultural R&D funding is that if you go back to 1861, when President Lincoln signed the act creating the United States Department of Agriculture, its primary goal was to develop and share information about technologies. Today, out of the total USDA budget, less than 1%, if we include SNAP as part of that, less than 1% is devoted to that, which was the primary raison d'etre for having a Department of Agriculture. So we've strayed a long way from trying to introduce and focus on developing aids to farmers to enable them to be more productive, which was the goal in 1861 and in the earlier 20th century, to a world in which, with respect to farming, the major goal is how can we write checks to farmers?
Yeah, and on the technology side, Vince, I was following an insurtech company providing services, technological services to insurance companies that had a belt with sensors, and a worker would be warned if they're bending the wrong way, if they're picking up too much weight, and it was something that was helping workers' compensation insurance. So construction companies with lots of construction workers easily spraining their backs, and so this technology was made available for use in the construction industry, but it didn't get pick up in the farming industry because it cost money. It cost money to have this technology, have our workers be safer. So the that technology development did not make its transition from the construction site to the farm field, where there's also the same issues of bending and lumbar back problems, lifting, sprains. So yeah, not a lot of action that I've seen from my perch looking at insurance.
Well, the issue is what should we care about? And workers' health is critically important. Access to healthcare is critically important, and that's true for everybody, regardless of occupation. But it is equally true for farming, and so some of the key issues around Medicaid, the Medicaid cuts, for example, many farm workers, this is not the owner of the farm, but a worker on the farm, receive relatively low incomes, and the changes in the Medicaid legislation may affect their ability to access healthcare, as some other changes may affect access to healthcare in rural areas in terms of just having facilities there that deliver care and folks there that deliver care. Those are significant issues that USDA, for example, should care more about perhaps than it appears to, in terms of where it puts its resources.
Yeah, Vince, I think the two of us are reading the same stuff. You mentioned harvesting federal payments as what a professor at the University of Illinois said about the Farm Bill program. He also said in that same study that this is about farming the federal programs rather than farming the fields. So these are kind of tongue-in-cheek characterizations of what we've been talking about. But we're going to open it up for questions. Actually, it has been open for questions, but before we do, if you had your druthers, if you were Caroline Queen for a day or King for a day, Vince, and wanted to do something to improve the the situation of crop insurance and it's in the Farm Bill. What would you address first? PLC, the ARC, the subsidies in crop insurance, research and development, disaster aid, impact of tariffs? What's the first thing that you would take on?
For me, I would probably go after the AIPs, approved insurance providers, and the guaranteed profit margins. That just is so unbelievably egregious that I would have to go for that first. But shortly behind that would certainly be obviously we would say like let's do away with the subsidies entirely, but operating still in a little bit of reality of that's very unlikely to occur. I do think that evening the playing fields where we're not subsidizing these 6 crops, which a lot of them are not used for nutrition. A lot of the stuff is used in a whole variety of other products, cosmetic products. I even heard from someone who knew someone with a corn allergy that they couldn't eat off paper plates because there's a little bit of cornstarch between each plate. To stop them from sticking, obviously. So I think bringing it more into a focus on nutrition and feeding American people versus large agribusinesses, getting as much government funding as they possibly can. That would be my top 2 things. Let's focus a little bit more on Americans' health.
Actually, before we get to Vince, on the subsidy reduction, not elimination, but really trimming around the edges. The Vince mentioned the CBO that's produced some numbers. The GAO has produced some excellent studies in the past, and in the most recent one on crop insurance, it says at the end that our recommendation is that the subsidies, the A&O subsidies, be reduced. This recommendation has not been accepted. So this is the last report was about 2 to 3 years ago, and I remember the folks from the farm lobby were panning the report. There's like a 70-page report by the GAO, these professional economists with good analysis, and the response from the farm lobby was that this is a terrible report. It's not true. It's made up. So a lot of opposition to some of the things that we're suggesting.
Yeah,
So-
and there was in our paper that we put together, quite a few of our reform measures, Jerry, were based on recommendations from the GAO. We had some of our own as well, certainly, but the GAO has been advocating for reductions in spending in this program for quite some time, but unfortunately, their voices have not been heard.
On the GAO in I think it's 1988, just before 1983, USDA sold one type of crop insurance policy to a limited number of farms in terms of the crops they produce. The 1980 Crop Insurance Reform Act mandated a switch away from that model to a model in which private insurance companies would deliver and sell and service the crop insurance policies that were sold. 1988, GAO looked back at that change and said, the public approach, having sales through the Federal Crop Insurance Corporation, as it was then called, was much cheaper than having the private sector companies sell and service the same policies. That holds true today. What is worse about today is that the crop insurance companies are now a multi-billion-dollar a year industry. And they know that they only exist as long as we subsidize individual farm-based policies. So as one individual who used to work for the Farm Bureau put it, he said, I would go into lobby for crop insurance in a representative's office with 2 farmers. I would go out the door and inward march the crop insurance company lobbies with 7 or 8 people. The real problem here is that we have a program that has 2 sets of lobbies, both of which are influential, one because of campaign contributions and the other because of bringing votes to the table, for a program that we know is wasteful and inefficient. So what I would do if I were king for the day, and I know nobody wants me to be king for the day, especially my daughters, but what I would do is simply end the current crop insurance program that ties itself to the individual farm. I would say, look, there are real issues created by catastrophic events. Those events tend to be relatively local at the county or sub-county level. And we can easily design programs that don't involve crop insurance companies at all, based on information about weather, which is 90% of the problem in terms of affecting farm yields, or the incidence of in the case of Alaska, for example, earthquakes and so on. Genuine catastrophic events that heavily adversely affect every farm in, say, a county or a sub-county level. And we can actually design programs to do that for almost every crop you could imagine. And if we have that, you have objective triggers. For example, rainfall in a 20-kilometer area. That would identify that losses occurred or did not occur in general, and would target payments to that area that would be designed to address shortfalls, say, when revenues or crop yields fall below 70% of the expected level or 80% of the expected level. We'd immediately save $4 or $5 billion a year on if we did that. And the truth of the matter is, we could cover far more crops than we're currently covering, because we could cover fruits and vegetables and so on. So the question is, what sort of loss should a farm, should we care about with respect to a given farm? And catastrophic weather events, extreme drought, catastrophic other events, floods, and so on. There's a role to help any company, whether it's a farm or, if we were talking about floods, whether it's a restaurant near the Mississippi. Treat farms as the businesses they are. Do the humane thing when catastrophes occur in well-defined local areas, not nationally, because catastrophes don't occur nationally. We're a huge country. If you have drought in the Texas Panhandle, it doesn't affect a farmer in Iowa or Illinois. So why are we designing programs like that? And the other question is, if farms don't have to face any revenue risk, because the crop insurance program and other programs effectively guarantee them a fairly high level of revenue on a per acre basis, is that a way to encourage entrepreneurship, innovation, focus on productivity? And the answer is no. The one place where these sorts of subsidies all went away almost overnight was New Zealand in 1984. And 5 years later, the entire sheep and livestock sectors that were benefiting from huge subsidies suddenly became a whole lot more productive. And those sectors have remained dynamic and productive and innovative over the past 30 or 40 years. We're doing the opposite in terms of creating incentives. We're creating incentives for what one of my previous colleagues, Henry Olson, called a comfy couch philosophy. If I know I'm going to get a guaranteed income stream or close to a guaranteed income stream, how hard do I have to work? And is that a good idea in a country where markets and entrepreneurship are highly valued? So I would go to a disaster aid program triggered by local events, not global events, to address real financial concerns driven by real catastrophic events that affect farms in an extraordinary way.
Right. Thanks, Vincent. That product that you talked about is something that the reinsurance industry is adopting in the form of parametric insurance, where if the temperature exceeds a certain amount or the rainfall is below a certain number of inches, it's triggered like that rather than this Rube Goldberg contraption, which is so complex that only a dozen people in the country understand how it works. So keeping it simple with parametric triggers is valuable. And I'm pleased to say that two of the questions that came in were already answered by Vince and by Caroline. What changes or alternatives would you suggest to lower taxpayer burden but still provide food security to make sure long-term production survives unprofitable years? And what are the top 2 to 3 reforms? I invite you to look at the study that Caroline and I did for the R Street Institute. So Melear and Theodorou in the website there. And one final question. I don't know if anyone knows this one. Maybe it's a tough one. What are the new subsidies for citrus growers? In the 1 minute we have remaining, does anyone know anything about citrus growers?
Oops. Now I'm ignorant.
All right, we'll leave that one unanswered, and we'll explore that and other issues. I want to thank you all for joining in this webinar. I want to thank Vince and Caroline for your depths of knowledge, expertise, and judgment. Really appreciate that. And we hope to see you again at a future R Street Institute event. Thank you, and hope to see you again.